What's up, all you Built by Bailey's super fans? Welcome back to the channel. It's going to get interesting now. This last quarter of the year, 2021, man, put on your seatbelts, get ready. As I've been talking about all year and been watching since March of 2020, I started to get a little wary of what is going to unravel in global markets. Now, I am not going to sit here and talk about financial stock market information because I'm not an expert. I do trade actively, but I am not going to be going down that hole because I am not the expert to talk about some of this stuff. However, I am going to talk to you about what you've clicked on this channel for, all right? The real estate crash. Before we do that, you guys know what to do. Subscribe if you like the video, hit the like button, hit the bell for notifications. Make sure you do that if you want to keep following me down the last quarter of the year and go down this rabbit hole with me as we watch the real estate market start to shake things up. And I'll talk to you about why that's going to happen. So make sure you guys do all those things. Subscribe, like, ding the bell, follow along. It's going to be a crazy ride. I'm going to help you navigate these waters and make sure you don't make mistakes. Make sure that when you get into real estate that you're doing it at the right time for the right price, and we're all going to make money. I don't want you guys to fret, but this is one of those times when we got to start really paying attention. So let's get into it. All right. You clicked on this channel in this video because you said, I'm worried about a real estate crash. And I'm sure you've probably already started going down the rabbit hole with a lot of other things, including Evergrande. What the F is Evergrande? Why does it have anything to do with my real estate investments? Let's talk about it. All right, let's get into this. Evergrande, what the heck is that? Let's talk about it. Evergrande is one of China's, I know, China's going to start affecting you again, one of China's largest real estate property developers, okay? They've got like 1,300 plus projects across the country, more than 200 cities in China. They actually are more than just a property developer. That's mainly what they do. I'm not going to talk about all the other things besides real estate and development that they do. I mean, wealth management, electric vehicles, consumer goods. There's all kinds of things they're into. Mainly, they're a property developer. That's what we're concerned with, okay? So, like I said, they're a real estate developer, but they've grown very rapidly, especially since 2010. Mainly due to the fact they've gone out and borrowed a bunch of money all over the world from different banks to continue their growth, continue to buy assets, meaning property and land acquisition, to develop property. And like anybody that borrows and borrows and borrows and borrows to continue to grow without kind of a backup plan, you get in over your head. You get caught with your britches pulled all the way down to your ankles, and sooner or later this catches up, all right? So what's happening is Evergrande is now starting to default on their loans. They're unable to make their payments, and these are just interest-only payments at this point, and then they can't even meet those. Now, guess where they're borrowing money from? Okay, you guys have heard the term financial contagion, I'm sure. If you haven't, we'll talk about that real quickly. It literally is just like a virus. I know, we don't want to even talk about viruses anymore. I know, we're all over this. But here's the situation. This financial contagion that we're talking about has to do with a company like Evergrande continuing to borrow money to grow a business. And for them, it's, like I said, land acquisition, develop projects, real estate property, okay? They're borrowing. A lot of this money is coming from United States banks. Now, globally, they're borrowing everywhere, but a large portion is from banks here in the United States. All right? So currently, they have $300 billion in liabilities and really about, supposedly, and I question even if there's this much, $15 billion in cash on hand. All right, so the Swiss bank, UBS, estimates that liability figure is going to be closer to $313 billion. Which amounts to about 6.5% of the total liability on the Chinese property sector itself. $19 billion is made up of outstanding offshore bonds. Okay, so a lot of what's being borrowed is borrowed against the bonds from different market sectors, different banks, etc. What does that mean? That means the more that a bank in the United States lends out, and I'm talking about a lot of banks, the more they lend out to Evergrande, the less they're going to have to be able to lend back out to other products here in the United States. At some point, those banks become illiquid. They run out of money, or they're unable to lend any more money out. Evergrande is not paying that money back to these banks. And now you can see the problem. So if the person lending the money isn't getting paid back and they keep lending money, what happens? It's a catastrophic snowball effect. And everybody's saying, oh, this looks like a lot like 2008. It does in some ways, and it doesn't. The difference in 2008 had to do with the economy and the way everything was set up financially through lenders, which is similar to this, but the mortgage was controlling the situation, and what they basically started breaking these products into, where they basically started reselling the investment, i.e. the mortgage, and what was in those mortgage packages, collateralized debt obligations, so forth. Credit swaps became the thing to get because everybody started seeing the problem with these investment packages, i.e. supposedly AAA rated mortgages that had a lot of goo boo boo poo 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 in them, all right? And none of that stuff was any good, and someone like this on a smaller level wasn't paying on that junky loan. So it goes up the ladder. If this isn't being paid, nothing up here getting their money back, and so forth, until at the top, the guy that's basically shoved all the money out to all these people is not getting paid back. Eventually, the guy at the top doesn't have any money left either. There you go. Giant bomb goes through. All right, so I've confused the heck out of you at this point. Well, I can't even talk either. Maybe I'm confusing the heck out of myself. All right, so that's what's going on. That's what Evergrande is. That's why we're talking about a potential big bubble bursting because of Evergrande and how that's affected. Now, that's going back to that financial contagion where there are so many investors and so many banks involved in Evergrande's debt that them defaulting on their own loans can be catastrophic to the markets here in the United States. Banks start to close. Guess what happens? We're going to see the same kind of scenario play out that we did in 2008. All right, so let's dive a little bit deeper into the financial contagion piece. Okay, so this is from Reuters as of today, and basically talking about what happened during the market hours for us, what is really going on. Okay, so shares in Evergrande, which have been scrambling to raise funds to pay many lenders, suppliers, and investors, closed down 10.2% at 228 on Monday. All right, this is on the Hong Kong exchange. After early plummeting 19% to weakest levels since May of 2010. And as I mentioned earlier, they started really going borrow heavy to continue to grow their company around 2010. Regulators have warned that $305 billion of liabilities, which we've kind of went through those numbers a little bit earlier, so you can see it's fluctuating. We're not really sure exactly what they have in liabilities, but it's over $300 billion for sure, could spark broader risks to China's financial system. Its debts are not stabilized. Keep that in mind. World shares skated in the dollar firm as investors fretted about the spillover risk to the global economy. U.S. stocks were sharply lower. S&P was down almost 2% today. All right. So you can see the contagion starting to work on our market. A major test comes this week with Evergrande due to pay $83.5 million in interest related to the March 2022 bonds on Thursday. So as of Thursday, they have a payment, which, by the way, has been graced until this date because they're actually past due technically right now. This $83.5 million payment is an interest-only payment on the total debt that they have. Has another $47.5 million due on September 29th for the 2024 notes from bonds. This is all money that they're borrowing. These are interest-only payments. They're not even able to now hit their interest-only payments. So both bonds will default if Evergrande fails to settle the interest within 30 days of the scheduled payment dates. Keep in mind what I said earlier. The people they owe money to are in large part U.S. banks. Okay? In any default scenario, Evergrande, teetering between a messy meltdown, a managed collapse, or a less likely prospect of a bailout by Beijing, I'm telling you that's not going to happen, will need to restructure the bonds, but analysts expect a low recovery ratio for investors, meaning you're not going to get your money back. Evergrande's troubles are also pressured by the broader property sector with Hong Kong listed shares of small-sized Chinese developers developer Sync Holdings, which is another one that's fairly big, they're down 87%, wiping $1.5 billion off its market value before trading was suspended. Okay, you can see the overall Chinese market's not looking real peachy right now. Evergrande executives are working to salvage its business prospects, including by starting to repay investors in its wealth management products with real estate. Stock will continue to fall because there's not yet a solution that appears to be developing to be helping the company to ease its liquidity stress. And there are still so many uncertainties about what the company will do in case of a restructuring. This is Kington Lin, the managing director of asset management development at Canfield Securities Limited. All right. Lin said Evergrande shares could fall below $1 if it forced to sell most of its assets in a restructuring. So let's look at this real quick. This is Evergrande the last few days, and you can see this rapid decline, breaking support levels all along the way. It did kind of pull a little bit at the end of the day today. Again, I'm not going to go through exactly why that was. This is kind of a false bounce. As of right now, I don't see any systemic risk for the global economy from the Evergrande situation, but there doesn't need to be any systemic risk in order for markets to be affected. David Bahnsen, Chief Investment Officer, Bahnsen Group, wealth management firm based in Newport, California, said in an emailed commentary. I highly and strongly disagree with that, but we'll see. There was some confidence, however, that the situation would be contained. Beijing has demonstrated in recent years that it's fully able and willing to step in to stem widespread contagion when major financial and corporate institutions fail. Yes and no. Despite mounting worries about the future of what was once the country's top-selling property developer, analysts, however, have played down the comparisons to the 2008 collapse of the U.S. bank of Lehman Brothers, which, by the way, is a big investor in this company. Now, I know everybody's going to try and play this 2008 collapse down if they were involved in any way in 2008. Many things started revving back up exactly in the same manner as 2008 debacles around 2015, and that I'm going to make a different video on here soon. All right, so in recap, we've got major players, major banks here in the United States, heavily involved with hands in pockets with Evergrande, which is a giant property developer in China that owes a lot of money to a lot of these banks, and they're not paying. Okay, so circling back to our real estate market, last quarter of the year, we're still going nuts in most parts of the country. Same scenario keeps playing out. Houses keep selling for way more than ask price. Buyers are not able to get in on anything that they really, really, really want. They're either continuing to lose out to a bunch of other offers, or they are forced to offer well over an ask price that has been drastically appreciated in the last few years, to a point where they're paying 15 to 30% over the ask price, especially here in my neck of the woods. Here's where I'm going to start getting into what's going to happen as far as a reset, or as some people keep calling it, a crash, giant correction inbound. Number one, first scenario, buyers are paying, like I said, 15 to 30% over ask price. That equates to $100,000 to $200,000 over the ask price in terms of actual dollars. Think about that for a second. Now, a lot of that had to do with inventory issues. The inventory issues were happening well before COVID was in place. COVID just made it a lot worse. Less homes went on the market, still the same number of buyers out there. Inventory continued to deplete. People became even more desperate to buy, again, offering a 15 to 30% bump over the actual ask price just to get a home. You get to a point when right now, just like in 2008, we're basically writing loans on anything and just saying, yeah, that property continues to appreciate at this rate. I don't see why we can't go ahead and loan them over, this percentage over the ask price. And if the buyer and the broker realize they may be pushing that appraised value, if they offered up to 30% over, they would just bring more money to the table. and they would just pay above and beyond the gap in appraisal. Basically, if the house appraised for no more than $400,000, that was the top end that the appraiser would say it's $400,000, no more. And the buyer said, I still want the house. I'll pay the gap in between the offer price and the appraised value. Their offer was $500,000. They paid above the appraisal another $100,000. Now, if you think about that, an appraiser saying $400,000 is the top end for this home, and the buyer says, fine, I'll just drop more cash into the house. They're now technically $100,000 upside down on the home. Some people are going to argue that, but I'm telling you right now, with everything that I've just shown you and dove into with the financial contagion issues and the fact that banks are now going to start running out of money because of this issue, we're going to have a bigger issue at hand. All right, so if you're following along here, hopefully you still are and I haven't lost you. Let's kind of tie this all together. So we've got a financial contagion issue with Evergrande. We've got banks that are going to slowly start depleting themselves of more money to lend out. All in the while, we've got a continued hot real estate market that, as you can see here, between quarter 3 of 2017 and quarter 3 of 2021, is now coming back to a more linear looking chart. That being, we're almost starting to size ourselves up for the same sort of continued growth, which is now slowing, that we had 4 years ago. Same kind of scenario, all right? High point was 14.6%. We're starting to see a little bit of a cool down, and those are for several different reasons, mainly because there are now less people actually still priced into this market. As I said before, people are paying 15 to 30% over ask price, and even with a fairly low, and I say that's subjective, fairly low interest rate for mortgages compared to what it has been, but we're not talking about 11, 12, 15% interest rates. It's still very low. But it is going to start moving up. You're going to have less and less people able to purchase a home, which is part of the reason why you're starting to see the market slow down slightly as we get into the last quarter of the year. More homes are continuing to go on the market, but less people are able to buy them because of the prices. Now, what happens in simple economics if you put something up for sale and you're waiting around for a while, and at that price, no one's buying it? What do? If you want to still sell it, you drop the price, right? So you start dropping the price until you get more buyers. But the value of the home is going to be dictated by the market, i.e. the buyers coming in to put an offer in to buy it. So if you think it's worth $1 million and it sits on the market for 2 or 3 months and you're like, man, I can't wait any longer. I want to sell this house and move. I need to collect my cash. I want to dip in and get my asset, get my investment back. I'll drop it to $900,000. Still no movement. $850,000. Boom. You got a plethora of buyers now at $850,000. Someone offers you $840,000. You write the contract. You're out of the home at $840,000. That's the actual value of the home. You thought it was worth $1 million. The market said the value is now $840,000. Now, as more and more of those similar type homes come on the market, because people are like, oh, John down the street did it, so let's do it. What did John sell it for? $840,000. All right, let's put it on an $840,000 and see what happens. Again, there's only so many buyers out there willing to start spending this money because, as you can see, that buyer pool has receded quite a bit because of the problem of just not being able to keep enough money in their pocket and afford a home. Okay? Now, also, income levels are not keeping up with the price of real estate. So as things get higher and the average or median, depending on what you're looking at, salary doesn't increase or follow suit, cost of living doesn't keep up, even less people are out there able to buy a home. More supply hits the market, some more people can gather it up because there's still some buyers out there that are able and willing to spend more, but it's going to continue with simple supply and demand economics to bring the prices down. Let's take a look at this movement in the last 5 years. As I was talking about, that continued hard push on appreciation of homes went pretty rapidly in that last 5 years. You can see this is the median price of homes nationwide from quarter three of 2016 of 258.7. We moved all the way to quarter three of 2021, which is where we're at right now. The median home price across the country is $382,500. That's the middle of the road home price across this country. That's not keeping up with the cost of living, okay? Now, there are plenty of people out there that have the ability still to purchase homes, but the inventory shortage is creating this massive rush on overpaying, and I'm calling it overpaying at this point because we're talking about a 15 to 30% offering over ask price when really the market has been pretty dialed in on what these home prices are. You can see this in pretty simple economics right here. Now you're paying above and beyond that 30%. There's going to be a point, what's called point of diminishing returns, where, as I was talking about a minute ago, there'd be no more people or no more buyers out there with the ability, even if they wanted to, purchase a home and be able to offer 15 to 30% over this crazy appreciation of home prices over the last 5 years. They just can't simply keep up. Cost of living is not going to allow more and more people to buy. Okay, so going back to that law of diminishing returns, there's a point where there's a buyer pool is going to be so depleted because of the actual price of the home or what they're going to have to offer in order to purchase the home that the home price continues to come down. Okay, the correction starts to happen based on simply a 15 to 30% overpay on the ask price. That's the first part of the correction. We're just going to correct back to what the market has said is the value, the actual value of the home, not the $100,000 to $200,000 over the ask price. It's what it's listed for currently. There's your first 15 to 30% correction. Then you got to look at inventory issues that we had even before COVID hit. And we're going to look at this chart right here, which is just showing you the main culprit and the lack of homes listed went from bad inventory to now here comes COVID. That literally is showing you how much further the pandemic pushed inventory down. That inventory, which is a normal ebb and flow through cycles and seasons, which should have been somewhere around here, is going to show up in the first quarter, especially of 2022. But more importantly, as things start to progress back to what we call a normal environment, we're going to have that missing inventory come back to life, which it is continuing to do. As you can see, we have the turn right here. We're starting to move back up. We've got to catch up to this number plus some, all right? So again, you're going to have more and more inventory hit the market. Still not going to be a buyer pool unless that buyer can afford the home. The home price, that first correction comes back to the original list price. Now we're continuing to drop. Now there's more inventory in the market. And then I go, great, I want to buy this home. Now here comes the financial contagion piece. You look back and you go to these banks, which a lot of them are going to be illiquid at this point because of the Evergrande situation. And they're going to say, I can't give you a loan. There's less money available to lend out to people that are now looking to buy homes. Well, if you can't get a loan, you can't buy the house unless you're paying cash for it, obviously. And most buyers can't afford a home that's cash only at $382,000 as the median home price showed. So more houses sit longer. Less buyers can buy them because of lending issues and liquidity issues now. And therein lies part two of your correction/crash of the real estate market. And what I'm seeing is running all the way into the middle of the summer 2022. Is Evergrande the Chinese Lehman Brothers? Well, it's funny they say that because Lehman is heavily involved in this too. Some have heralded Evergrande as Chinese Lehman Brothers. The bankruptcy of the investment bank in 2008 was one of the catalysts for what became the 2008 financial crisis. One key is that Evergrande's offshore bonds are likely to be restructured, and most of the debt is held by large global funds that aren't banks or other financial institutions, according to Ryan Dietrich, chief strategist at broker LPL Financial. Lehman Brothers was on the books for most of the other major banks, so its failure was more broadly felt. I slightly disagree with this. Okay, but keep in mind that a lot of those banks are heavily involved with Evergrande, and there's a similar situation to 08 from what I've just kind of summarized in all of this, and that's why we have to pay attention to this in the coming months, in the next several quarters for our real estate market in general. Okay, guys, there's the doom and gloom, albeit we still have to pay attention. One of the biggest next steps, like I said, was Thursday to find out what Evergrande does with their next interest payment. Do they make that payment or not? I'm not real confident in that happening. And pay attention, keep watching my videos, keep going out and watching these markets. But more importantly, if you haven't, hit that subscribe button. If you like this video, hit the thumbs up, ding the bell so you can get more of the information. I'm going to keep putting these videos out as we kind of pay attention to what's happening in the financial contagion region of our situation with real estate. All right. Keep your head up in the meantime. We'll keep watching this. I'll keep you guys informed as much as I can. Thanks for watching. Until next time, guys, keep building.